How interest rate cuts can lead to stock market crashes. Interest rate cuts are generally seen as positive for the stock market, but under certain conditions, they can coincide with stock market crashes. Understanding this requires considering various economic situations and policy responses. Signals from interest rate cuts. Economic crisis signal. When central banks cut interest rates, it often signals economic difficulties. Investors may interpret this as a sign of impending recession, leading to negative impacts on stock prices. Loss of confidence. If investors believe that rate cuts won't rescue the economy, it can result in a stock market crash. 2. For example, in severe economic downturns, rate cuts may not alleviate investor fears. Historical examples of interest rate cuts and stock market crashes. 1. 2008 global financial crisis. Context. The subprime mortgage crisis and major financial institution failures put the financial system on the brink of collapse. Rate cuts. The Federal Reserve drastically cut interest rates, but initial market panic persisted, causing significant stock market declines. Stock impact. Despite rate cuts, Lehman Brothers bankruptcy triggered a market crash. Later, continuous rate cuts and quantitative easing helped in recovery. 2. COVID-19 pandemic, 2020. Context. The global spread of COVID-19 halted economic activities, severely impacting the global economy. Rate cuts. Central banks worldwide slashed rates and introduced extensive fiscal and monetary policies. Stock impact. Initially, stocks plummeted despite rate cuts. However, extensive stimulus measures eventually led to a rapid stock market rebound, indicating short-term drops but long-term recovery. Mechanisms linking rate cuts and stock crashes. Psychological impact. Rate cuts may be perceived as a sign of economic weakness, diminishing investor confidence and triggering stock sell-offs. Liquidity issues. Severe liquidity shortages within the financial system may not be resolved solely by rate cuts, potentially leading to ongoing stock declines. Policy expectations. If markets have already priced in rate cuts or if cuts are seen as inadequate or delayed, stocks may continue to fall. Conclusion. Interest rate cuts do not always lead to stock market increases. Depending on economic conditions, they can be associated with market crashes, particularly if the cuts reflect severe economic troubles or if they fail to meet market expectations.